when we do have an appetite for commercial, we do 65% of the stabilized value, no loan to cost ratio, which makes us very unique. You don't typically see that. So you could literally buy and do your construction and we'll fund the entire thing. So it eliminates the need for syndications and partners at your 12% rate instead of half the deal.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris.
Our guest today is Kevin Amolsch. Kevin is he formed Pine Financial Group in 2008 after leaving a small mortgage company as the senior loan officer. Your timing was impeccable there, Kevin.
Perfect, right?
Yeah. Kevin's got a degree in finance, which he obtained after serving 4 years in the U.S. Army. Kevin started out in banking, working at First Bank in the lending department while in school. And from there, he started a real estate investment company, which is still active today. We could go on. I don't want to do the whole bio here, no Kevin. Worries. So what I find fascinating, I always love talking to veterans and how they transitioned into real estate investing. They've got all sorts of crazy stories. What initially sparked your interest in real estate?
Yeah, that's a good question. And I go back to my time in the Army, and I was very frugal, always have been, raised that way. So when you're in the military and you're living on base in the barracks, you don't have expenses. So my food was covered, my housing was covered, everything's covered, right? So I'm not spending any money. I'm not making very much, but I did have a little savings going. And it's like, what am I supposed to do with this? I didn't have any idea. And I knew the bank rate wasn't going to get me where I want to go. So I just started reading books, and I picked up that purple Bible that we all have read. And that one led me to another book and then led me to another book. And everything I was seeing is real estate is the tool to make people rich. This is like almost like a guarantee. So I just really focused in on that. And I tell you, after that first deal, I just fell in love. I knew that this was going to be the path to my wealth.
So what was that first deal? And let me back up and unpack something. So we see a trajectory with a lot of real estate investors where, especially young people, they start out wholesaling because they don't have money. And then eventually, if they have success with that, they start flipping. Or someone starts watching HGTV and they decide they want to flip house, and everybody stumbles on the first one or two, but then they finally start getting success. They realize they're trading time for money, and eventually get to the point where they want to hold rentals long term. Eventually, they get to the point and realize that single families is a very slow way to do that. They'll get into small multifamily, larger multifamily, and a lot of times over a 20, 30-year career, a lot of those people end up as passive investors into syndication because they'd rather make a little bit less and do none of the work. Where did you start, and kind of what did the trajectory of your investing look like that you ended up on the financing side of things?
Yeah, Clint, I love how you describe that, because that is a very common way that people go through their career, right? So for me, that first deal, I just bought a house, I just moved into it and rented out the bedrooms. And what do they call that? House hacking now? That wasn't a thing back then, but I was house hacking before that was a term. And I moved out of that. I actually used my student loans as a down payment on my second house because I had the military paying for my school, but they still offered me loans. So I took that at whatever it was, 1.5%, and used it as a down payment, bought my second house. And then I kept my first one as a rental. I was 23 years old and I had a rental property. So I actually got super lucky because I had a lot of success with that first one until I didn't, right? Those are always fun stories, but worst tenant eviction in the history, I think. It was terrible. But up until that point, I was making money every month. I was seeing the appreciation. This was back in 2001, 2002. I saw the tenant paying off my mortgage for me. So I was like, yeah, this is why I wanted to pursue real estate as an investment. And I went in it hard. Like I spent pretty much all of my spare time literally calling people on the phone as I walked between classes in college, just calling for rent by owner, for sale by owner, anybody that showed any signs of possible motivation or wanting to liquidate their property. And I was setting up meetings, one-on-one meetings with them in their home on the weekends. So during the week, calling, weekends, meetings. And I was buying 1 or 2 houses a month without any cash or credit, right? Because I literally, my refrigerator, you guys, my girlfriend came over and she makes fun of me for this, but I had a can of green beans and a keg of beer. That was what was in the, I didn't have
essentials,
money, right? But I was able to buy the house or two a month. And what I learned through that process is the financing side of real estate is where my passion is. Look, when you guys are active investors, so you know this, when you're out there shopping deals and negotiating and sending in your LOIs or your offers, it has everything to do with how you're going to take the property down, right? Are you going to ask for some owner carry? Are you going to ask for some concession? Whatever it is, it has everything to do with the funding. So I really just focused in on the funding and became a mortgage broker, which was terrible, learned that quickly. And then I started raising private money. And this is where I landed. 2006, I started raising money. 2008, I started Pine Financial. And here we are 16 years later. And it's just been an absolute blast.
So let me ask you this, a quick answer, and then I'll ask a follow-up question. Was it basically the equivalent of driving for dollars and making those calls and doing those deals? Is that what created formed your decision to go into finance? Or was that the other way around, that as you fell in love with finance throughout the process of getting your degree?
I fell in love with financing because of the real estate side, but it wasn't the cold calling, right? That sucks.
Right.
Let's be honest with ourselves here. But it did get me in the living room, and that's where it's fun. When you're actually trying to solve somebody's problem and make a profit doing it, it's just a negotiation, right? It's like you're just massaging the terms. That's where I fell in love with it.
I love that happened at a young enough age that you could make the decision to get a finance degree.
Yeah,
instead of a lot of time people figure that out, the side of real estate investing that they love, after they've got a marketing degree or pursuit of music or whatever it is, and that kind of happened at the same time where you were able to get a degree and pursue that passion as a career. So tell us a little bit about the need that you saw in the marketplace. 2006, 2008, I'm sure that was a very tough time. Tell us a little bit about that, and tell us about what Pine Financial Group does and why you created it and what need it fills.
Well, the need, I was an investor, right? I was in the trenches. I was fixing and flipping, and I was doing lease options and subject twos. I knew there was a need for money for investors, especially leading up to the crash. I mean, things were starting to get tough there. And the need was some flexibility in funding. So we created that by raising capital, and we took control. I mean, I say it was really me. I knew that being a mortgage broker was terrible because I was at the mercy of the bank, right? I was just brokering their money. It wasn't my money. I didn't make any decisions. And guidelines were changing so quickly. So I discovered that if I can get control of that underwriting and make common sense underwriting decisions, I could really get control of my business. And so that's what I did. And it really helped real estate investors. I'm an investor, so I focused in on that niche. And that's where we went from there. Pine Financial, I can't remember the second part of your question there, but I could tell you that Pine Financial makes loans to real estate developers. So if you have any type of value add, that's where we're involved. Fix and flips is the big one. BRRRR strategy, we were doing that before that was a term also, but the buy and rehab and refinance, we do a lot of that. And then to some extent, we're in the commercial space. About 20% of our portfolio is commercial value add, similar to what you guys are doing. So that's the funding that we provide.
So you talked about how funding makes the deal.
Yeah.
And that's a nuance that a lot of inexperienced investors miss. You make money when you buy, but part of that buy is the funding. You're either buying it for cash, which is, the simplest form, or you're buying it at the right price and you're getting the right funding. So talk to us a little bit about what you mean by that.
Well, I mean, this is the perfect time to be talking about this because look, higher for longer, right? We have interest rates that are 6.5% in the commercial space, and we have cap rates that were floating at 5 and 6%, right? So now that's what creates what we call negative leverage. Negative leverage for the listener is when the return on the asset is less than the leverage. So your loan payment, your loan interest rate is higher than the return the asset is producing. And what's very interesting about negative leverage is the more money you put down, your bigger down payment creates a higher cash on cash return. Well, that's not how real estate's supposed to be. You're supposed to limit your down payment to produce a higher return, right? So literally you take more risk, you get a less return, right? So it's very interesting, the time that we're in right now. And I'll tell you what, when you see interest rates rise like we have, that's the terms of the loan, right? That's the terms of the money. You could have owner financing terms, you could have private money terms, you could have bank terms. This is just a term of the loan. And when the interest rates go up, cap rates don't always go up as quickly. So what it does is the cap rates slowly start to increase to catch up to those interest rates, which brings the values of the properties down, right? So you're buying properties at a lower or better value because the terms of the loan are not as attractive. When those rates go back down, that like helps real estate values, right? Then you'll see the values go back up because cap rates will come down.
Yeah, that's what a lot of people miss is that, and that's been the struggle that a lot of the commercial space has been in lately, is with that rapid rise in interest rates, cap rates
Right.
took a long time. And a lot of those owners that were holding those properties and thinking about selling were basing their values off of, 6 months ago,
A comp, right?
a comp, and now the buyers are coming in and going, I can't make this work at these new interest rates. And a lot of those owners are going, well, I'm not backing down. And so, so then the property just sits and sits and sits. And then eventually, as you said, the cap rate starts to catch up, starts bringing that value down. And now it meets that point where the opportunity reemerges.
Yeah, and you'll see those cap rates start to soften now, right? And you probably already are, because the expectation is rates are sort of at their peak and probably coming down over the next 12, 18 months. And so that when you anticipate that, it gets built into the price often, right? Oftentimes it's built into the price. So I think you'll see that.
You mentioned fix and flips, and you also mentioned BRRRR strategy. So obviously both of those are, with the BRRRR, there's a refinance coming.
Yes.
And with the flip, there's a recapitalization coming by way of liquidation. So are you guys offering, is this like DSCR type money that you will hold on, like in terms of the term, longer term for rental properties, or is there always some kind of recapitalization that's part of the business plan in terms of a flip or a BRRRR or refinance, whatever it may be? So kind of what products are you guys offering? What kind of terms are we talking about?
Yeah, I want to touch on the DSCR because you mentioned that. And I think that's such a weird term. So DSCR is debt service coverage ratio, right? It's a ratio that underwriters use to manage risk or evaluate risk, right? So if there's to keep it real simple, most banks are looking for like a 1.25 DSCR on the commercial side, which means for every $1.25 in income, net income, $1 of that is allowed to go towards the mortgage payment, right? So 125% of the loan payment in net income. And that's how banks stay safe. So all it is a ratio. But all of a sudden, now we have a DSCR loan, and that's the name of the loan. All that is a ratio. It really doesn't make any sense. But for the listener, what a DSCR loan is basically a stated income loan. So you're looking at the income from the asset, not the income from the guarantor or the borrower. So it does help with these smaller single family duplex, small multis. It helps with funding them if you're not able to qualify at the bank, right? And so these are typically private type lenders, maybe family offices or hedge funds that have some more flexibility with their underwriting, and they're willing to hold that paper on their portfolio. They don't sell the loan off into the secondary market, so they keep it, right? So that's what the DSCR that you're describing is. We don't do DSCR loans because we're a short-term value add lender. DSCR is typically turnkey, so it's already producing income. Otherwise, you wouldn't qualify for the DSCR. So everything we do is short-term. Let's add some value to the real estate and get out. So BRRRR, great because you're refinancing. Flip, great because you're selling.
Got it. So you're doing BRRRR loans, you're doing rehab loans, just short-term value add. What does a typical term look like on a Pine Financial Group?
Yeah, and I totally skipped over that question, Clint. I'm sorry. You did ask me about the terms. So we're looking typically a 9-month loan unless there's like some major value add. Like if you're adding a big extension or, doing a pop top or something where you're adding to square footage. If it's just a regular fix and flip, 9 months, okay, and we're typically 2 points, 12% interest only. We do like payments every month because 2 reasons. It applies pressure, which means you move faster and you end up making more money. And then if there's a problem, we know immediately because you're going to miss a payment. Right? So we do require payments, 9 months, 2 points, 12%. That's very common.
Let me ask a question. So what's the longest, if it's a heavy, heavy value add? And the reason I'm asking is obviously selfish. Like we buy old Kmarts and grocery stores. We convert those to climate controlled storage. On average, it's going to take us 12 to 15 months to build it out. We have in-house construction and build it out. Well, it's worth a lot more when we're done with that. And you technically could refinance then if you wanted to. But from there, it's going to take 18, sometimes 24 months, depending on the size of the facility, to fill it up. Now, it's cash flow positive at 40% occupancy, and this thing's going to be a monster cash cow on the back end. But now we're talking about a couple years, right? A couple years of basically interest-only payments is the financing we're currently getting. For a larger project like that, is there a product that you guys have or a timeline, or is that just kind of out of your niche and you guys have, you know what you're good at and you do one thing?
Yeah. So we, like I mentioned, we're 80% resi, 20% commercial. So on the commercial side, we're actually on a pause right now. So I'm just going to be real transparent with you guys. We're not taking on any new commercial because we need to properly allocate our portfolio. With that said, when we do have an appetite for commercial, we do 65% of the stabilized value, no loan to cost ratio, which makes us very unique. You don't typically see that. So you could literally buy and do your construction, and we'll fund the entire thing. So it eliminates the need for syndications and partners, and it's, you know, your 12% rate instead of half the deal or whatever you share with your private money guys. So typically it's a lot cheaper to bring in debt instead of equity. 65%, 2 and 12, and we would go up to we would go up to 2 years, and then we would have to discuss like a renewal or some type of fee, something like that.
Got it. Okay. Follow-up question. This is probably going to be a little bit off the beaten path for most of the questions that you get asked. And if we need to redirect, we certainly can. But I want to ask this question from a capital raising standpoint. So I'm a general partner in syndication. Neil and I do the investor relations, which in our opinion means investor education, and then talking about goals and see if there's alignment there. Our job is to raise the capital that we use to go buy these projects, do the construction, and convert them into climate-controlled self-storage facilities. Now, when you started Pine Financial Group, obviously you're becoming a bank. So when you are becoming the bank, what does it look like behind the scenes in terms of how did you raise capital for that? Are you continuing to raise capital for that? Or like the funds that you guys are lending, you're obviously holding them in-house because these are very unique deals. Where's that capital coming from?
Yeah, and it's evolved over time. So I'll take you back and tell you the story. So when I started in 2008, I didn't have any credibility, right? So it's hard to raise money when you're just getting started. So the way we did that is one individual private money investor, one fix and flipper, and I just brought them together. And then that way, the pitch was, look, you're in first position, you're lean, you could see your name in the public records, all of those things. Well, then the feedback was coming in where we need more diversification, we need some liquidity, we need smaller investment amounts. Like, so how do I solve that problem? So we created our first fund. That was in 2009. And that solved all those problems. But now we have some credibility and now we're getting referrals, right? But to get going and actually start bringing in the capital from private investors, it really is education. So I love that you said that. You educate your investor base. I think that's huge. And that's it. First of all, it helps them, right? It helps you and it makes you credible. So they will want to invest with you. So that's exactly how I did it. We didn't have podcasts back then, but I was literally standing in front of a room of 20 people and teaching them how to flip houses. And then at the end, I'd say, if anyone has money and they don't want to actually do the work, let me know. I could help you with that. So that it just, I guess, snowballed from there. Now, this is like an actual industry, private lending. It wasn't back then. Honestly, I felt like I invented it. And then I went to a private lending conference and I was like, oh my God, I'm like the smallest guy in this room. Everybody's doing more than I am. So that was very humbling, but now it's an industry and there's institutional money coming in. So I mentioned family offices, hedge funds, all of that's true. You could package private loans up and sell them off like you would do with Fannie and Freddie. I mean, Fannie and Freddie is not your buyer, obviously, but you could package them off and sell them off to investors. And then there's banks coming in and offering guidance lines. So now we pledge loans and we get banks to invest in us. We got about, a little over 30 million in bank money, and then 160 or so in private individual investor money.
Wow. Okay. That's really cool. I love how that was kind of organic grassroots and growing it out from there. So that's really impressive. In terms of, so the economy has a lot to play here, right? I understand you're doing short-term loans. The thing about short-term loans is you're only making money when the capital is deployed, right? When it's back in your hands, it's sitting on the shelf, and that money has to get up and go to work every morning, whether we want to or not, right? And I love the idea of your money making more money for you. That having been said, like, how does that play in terms of the return for you guys when the economy's up or down, right? There's always opportunity. I'm a firm believer that you can operate in any market. The deals may just change a little bit. I spent a 16-year career in medical sales. I started investing in real estate on the side. I followed the trajectory that a lot of people do and eventually ended up in multifamily properties. I was converting to Airbnb and I got burned out on that. And as I was looking for the most passive investment strategies that I can find, ultimately, when I talked to the old successful people, it was three things. It was hard money lending and note lending. It was mobile home parks, and it was self-storage. I chose to go the self-storage route because I like the idea of renting people a box of air, and I was burned out on tenants. So I didn't want to do mobile home parks. The hard money lending side, obviously you have to have money to get started from that side. And I obviously didn't have that at the time. But that money is only earning a return when it's out there. And we have had some people that were doing hard money lending to fix and flippers recently that decided to invest into nomad self-storage deals because they're more consistent and it's more of a timeline. So is this kind of one of those things that like the market's up, the market's down? I certainly know people still flipping houses right now and having a lot of success with it. The deals have changed, and I think things have changed for some wholesalers out there as well. But in terms of what you saw, like what happened in 2008, right? In 2008, 9, and 10, I remember that there were deals everywhere. Between 2010 and 2013, my wife and I bought 9 single-family properties for dirt cheap. We were still recovering from taking that on the chin. But the problem was you couldn't get financing for them. So I was paying cash for them one at a time, and it's a very slow way to go ahead. So I know that I personally think we're in a little bit of a recession right now, whether anybody wants to admit that. But compare what we're seeing now, and if you're seeing a slowdown compared to what was happening in the market back then and what that does to your return as a lender.
It's such a fantastic question. And I get that one frequently, as you could probably imagine. And so I went back and I looked at 2008. Look, I lived through that. I had 55 houses, single family houses when that crash started. So I know exactly how that felt. And I started buying at that time as well. Look, this doesn't resemble 2008. It's not even close. What it does resemble is the aftermath of the savings and loan crisis. So if you think about what we're experiencing now, it's a fight against inflation, right? And the government's fight to win that fight, you have to put the economy in a whirlwind. I mean, so you got to create chaos basically in order to get inflation down, which is exactly what happened after the savings and loan. High inflation, high interest rates to combat that. So I think there's a lot more resemblance to 1990 when real estate values, I say crashed. It went down 14%, which is actually a crash if you think about real estate. Take 2008 aside, but real estate values don't typically go down in recessions. It's not common to see that. But they do obviously go down at some points. In 1990, they did. So I compared the 90s housing correction to what we're experiencing today because it's more in line. And then I wrote a report about that to share with everybody because I get asked it all the time. So thepinereport.com, you can get that report for free. But coming back to your question about the market and how we navigate that, look, I agree with you, Clint. You can make money in every single market. Now, I get asked constantly, is this a tough time for you? And I guess statistically, it probably should be. We have high interest rates, so that makes our leverage higher, our margins smaller. You have low inventory pretty much across the board, definitely in the markets we work, which creates thinner margins for fix and flippers. If there's not a lot of inventory, then owner-occupied buyers start buying wholesale type transactions, right? They're willing to spend more on a beat-up house because there's nothing else to choose from. So that drives wholesale prices up. But retail prices sort of have a ceiling. It takes a little while to get through that ceiling. So all that does is shrink the margin, right? So this would be a tough time. But look, banks aren't lending, right? Just like 2008 and after the savings and loan. Banks aren't lending. They're scared. There's actually two things. First of all, their peers have started to fall. We've seen that with Silicon Valley. And two, we know regionals are starting to get purchased. So now the bigger banks are hoarding cash so that they can go out and grow. So they don't want to loan out money because they want to meet deposit withdrawal requirements or demands, and they want to maybe acquire banks. So what do? They tighten guidelines. They stop lending money. So guys like us benefit from that. So there's a lot of a lot of private lenders that are bankable, or a lot of real estate investors with bankable deals that can't get money that we're financing. So we are thriving. We absolutely need more capital because we can't keep up with demand. But look, I've been doing it since 2006. I started investing in 2001. So I've been through the .com. I've been through the crash. Now COVID. Like we've seen the cycles, and we've been successful in all of them.
I love that, because you're really loosely tied to the banking industry. Like you're walking alongside them, and it matters. But really, when you're an alternative lender, it's probably hard to peddle your product when you're at 10 or 12% and the banks are at 3 or 3.5. Right? That's tough.
Sort of.
I'm sure that there's a difference, but like right now, not only did interest rates go up, but the loan to value and loan to cost, went from 80% to 65 in some cases, especially on the commercial side. So anytime that there's volatility like that, I see the situation where that definitely makes you more appealing. It's like, well, why don't I just pay a few more percentage points and just do this with, a private lender and do it separately from there and pay interest only for a period of time. And it's, we got to keep it going. You got to keep the crews working. You got to keep flipping houses. So instead of jumping through all the hoops with the banks, or the banks are freezing lending right now, it's like, you know what, if I can find good enough deals, I would rather just pay a little bit more for the funding, because I know I'm going to be out of the project in 6 to 9 months.
Yeah, all of that's true. And I agree with everything you just said. And you're focused on the pricing, right? But what about the house that's falling off the foundation? Do you know a lender that will do that? What about a apartment complex that is 100% vacant? Are any banks looking at that stuff? No, you need alternative sources to get those stabilized, right? You got to fix that foundation so you can get it rented out or sold. You got to get the occupancy up so a bank will want to touch it. Now, that's not every bank. Some banks are value add and they will look at that stuff, but typically that's not.
I love the fact that you guys are also focused on the LTV and not the LTC, right? The loan to value versus the loan to cost, so that you're allowing people, if I'm understanding this correctly, capital for the purchase of the property and the renovation, because you're looking at the ARV, the after repair value. So if you're buying a property for 50 grand and it needs $20,000 worth of work, you're into it for 70. But if you look at it and you're like, the after repair value on this property is 120, then you'll give them 65% of that, which is going to be more than enough needed for them to buy the property, fix it up. And then when they sell it, that extra 35% of equity basically is their profit margin.
Yeah, you got it. And I said 65, that's on the commercial side. On the residential side, because those assets are more liquid, like it's easier to sell a house than a Kmart, right? So we go to 70% on those.
Okay.
So 70% loan to ARV, no loan to cost. So in your example, if that house is worth 100,000, we'll loan up to 70. Buy it for 50, 20,000 in construction, we'll fund the whole thing.
You heard it here, folks, listeners. That is zero money down investing the easy way. You're going to get rich overnight. Super easy. Call Kevin. You're going to make a fortune.
Yeah, that's funny. All the books tell you you're going to get rich in real estate, which is true. I think it's pretty much guaranteed. If you're in it long enough, you will get rich. But you have to be in it long enough. It really isn't a get rich. It is a get rich fast. It's a get rich, but it's kind of slow. It's just like a guarantee, I think. So stay in it long enough and you will be wealthy. Guaranteed.
Yep, that's true. It's a forgiving asset class. Even if you buy a deal that's not a good deal, if you wait long enough, time usually turns it into a good deal. So it's funny, those, when you do those single family homes, I was buying small multifamily and converting them to Airbnbs, which changes the asset class, changes the formula, drastically pushes up the value. We're doing the same thing now. We're just buying nasty old Kmart buildings, converting them to storage. It's the same thing. It's just a couple more zeros. So the lessons that you learn on those smaller properties are the same lessons you use later. A lot of times the relationships that you make early on are the same relationships that you'll use later on, which is why it's always good to be ethical and transparent with everybody. And even if the people you're working with can't help you with what you're working on, it's likely that they know somebody else. In terms of the way that you guys are vetting your operators, like if I'm a fix and flipper, my first fix and flip that I did, I was supposed to make 30 grand and I made 8, I believe, 7 or 8.
Right. Yeah.
Yeah. So then the next one I was supposed to make 50 and I think I made like 26. Then the third one, we made 85, which was the number that we were hitting for, right? So we got there, but everybody takes it on the chin for the first couple, which I understand luckily, if you're at 70% loan to value, you got 30% wiggle room there for you guys still to be able to get out of it and get your money back out. But how are you vetting operators and picking the different people that are working with you? And how are you looking at the properties and underwriting and making sure it's something you really want to be in first position of?
Yeah, and you hit that. We're looking at the asset first. So 70%. We want to make sure that that's an asset we can handle. Which we didn't talk about this, but we're pretty geographically focused on the residential stuff because we want to be able to get in and complete the fix and flip if we need to. So we're highly focused on the asset. As far as the borrower or the guarantor, we care about reserves most. But by far, the most important thing is your liquidity. We just talked about no money down financing, which is true. You don't need money to close on the deal, but that doesn't mean you don't need any money. And everybody goes over budget. Pretty much everybody. Our best clients go over their budget. Okay, it doesn't sell for as much as you think it's going to. That's pretty common, and it takes longer. So you said you only made 8, and you were expecting, what'd you say, 35 or something? That's very common.
30, yeah.
I mean, even experienced investors will see that. So you probably went over your budget a little bit, right? So if we had a budget of 50 and that's what's in escrow to release to you to you do your construction and you go over that, you have to fund that. You have to make the payment. So we just want to make sure that there's a little bit of liquidity so that we're all being smart and safe. Outside of that, experience is important to us. Now, you don't need to be experienced necessarily yourself, but we want somebody on your team helping you that has experience. So whether that's a realtor, a mentor, somebody that could help you through your first project or two, that's also important to us.
Now, Kevin, the title of this podcast is Truly Passive Income, and we've spent the last 30 minutes talking about the benefit that Pine Financial Group provides pretty much to active investors. And Clint's pretty much just been picking your brain because he's selfish and wants to know this stuff, which is fine. But I want to understand the benefit. You said you have family offices and you have retail passive investors who invest with Pine Financial Group in order to get a return. How does that work?
Yeah, so we don't actually have family office investing with us. I mentioned family offices because they're in the industry. They are investing in this asset class. Most of ours is just high net worth, but it doesn't have to be. So we have a public fund, which is pretty rare in this industry. It's a Reg A, and all that means is we could advertise it and we could accept non-accredited investors. So that's the distinction between a Reg A and a Reg D. Reg D is a private offering, and now because of the Jobs Act, you're allowed to advertise, but it's accredited investors only, and you have to go through this qualification process with them and all of these things. So we do non-accredited or accredited, and it's a flat 8% return. So it's not your syndication like investing with you guys where you're probably much, much higher than that. But it is consistent and it is cash flow, and it's going to be every single month. And so it's one of those things that help diversify portfolios into some consistency.
So first question, are you guys able to accept 1031? And is there the opportunity for that 8% to compound if you don't take it out?
Yeah, the answer to the second part of your question is yes. A lot of investors do that. In fact, IRA investors, very common. We have a lot of IRA investors because it does compound. The first part of the question is tough. And this is one I get asked frequently, Clint. And here's the problem. We're lenders, not investors necessarily. Like I invest my own, but Pine Financial is a real estate lending company, not an investment company. So we don't actually own the real estate. So as hard as I've been trying, I've been paying attorneys and accountants and like, how do we get this 1031 money? Because can you imagine how much money would come in if we could figure this out? Right. And it's just not possible, except there's maybe a way to do it through a trust, but the legality of that is questionable. So we have decided not to do that. The answer, I know it's a long way to answer your question, but no, we're not taking 1031s.
No, it's not, because that was kind of my question about, can you replace the debt? And you're pooling money together. So like the only way to do it would probably be with a tenants in common,
right?
If you're pooling the money, or a Delaware statutory trust.
You got it.
I've come to learn that anytime the words Delaware statutory trust come up, you better slow down, because you're likely to be getting into a gray area. And if you want to keep doing what you're doing for a long time, it's best to avoid the gray area. So there's some pitfalls there. So I was selfishly asking to see if that was something you had navigated.
Yeah, and for the listener, they probably know, but the 1031 is a like kind, right? Real estate for real estate, and this is so because it's paper investment, not a real estate investment. That's where we're getting tripped up.
Got it.
Kevin, can you talk about a specific project that you funded that had a significant impact on either Pine Financial Group or the community that it was in?
Oh, that's a good question. So I've got several that have come to my mind. The first one is in Colorado, down south near Highlands Ranch, if anybody's familiar with Colorado. It was an old dark Safeway. And similar to what you guys are doing, they're converting the big box into something else. And interestingly enough, this was right when COVID was hitting, and they had a Vasa Fitness, and they were actually already starting their build out. The demising wall was in, and they were starting their tenant finish. So the lease was signed and everything. And then it was also a swim school. So it converted a Safeway into a Vasa Fitness and a swim school. And then COVID hit, and gyms were going out of business left and right because you can't go work out, right? So Vasa ended up paying $1 million to break that lease. Swim school stayed in, and then it ended up going to, I think it's a Planet Fitness now. So it still went the fitness route, but that changed the community because a dark Safeway, as you know very well with what you do, is terrible for the neighborhood. And so now we have a thriving community and, a 7-figure income for our client.
Love it. Well, listen, Kevin, we could sit here and talk for another 2 hours. But in the interest of your time and our time, I want to thank you for sharing your knowledge with us and our audience. And if any of our audience wants to reach out to you and find out more about you and Pine Financial Group, where would be the best place for them to do that?
Yeah. Thank you, Neil. I think the best thing for the listener is to check out that report because we are in interesting times right now. So it's thepinereport.com. And there's actually your 2 reports on there, the market one, which I think is super important, but also if you're interested in private lending and you want to be safe, like if you're out there on your own, you can make more money, right? So by all means, if you want to do that, but be smart about it. So I wrote a report to help keep your money safe. Those 2 reports are at thepinereport.com. Otherwise, you can reach us at pinefinancialgroup.com.
Excellent. Thank you, Kevin. Appreciate that. Last thing, and we're absolutely going to hold you to this. When's the next rate cut coming?
It's so interesting because they're saying September, right? But that's right before the election. So I don't know that's really going to happen. It is priced in now in September. So the expectation is that, but I don't know.
It's going to raise some eyebrows if they do.
Right? It's a 50-50.
Yeah.
The market thinks it's more like 80% or something.
Way to take a stand. Thanks, Kevin. I appreciate it.
Yeah.
Hey,
Well, it's funny. Hang on. It's funny because I just heard yesterday that Trump reached out to Powell and asked him to not cut rates before the election. And of course, now that puts him in a position of, it's what a mess. What a mess.
What a world.
I did not hear that. That's interesting.
Anyway,
yeah,
I read the same thing. Hey, Kevin, listen, I appreciate it. I love what you're doing. Thank you for your willingness to come on and educate our listeners. So thanks so much for your time.
I appreciate you guys. Thank you.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.